As the election cycle heats up, so does chatter about how stock markets perform during election years. Hi, I'm Matthew Carvalho, Loring Ward's Director of Investment Research. Now, according to Wall Street conventional wisdom, presidential elections are supposed to produce strong market returns. The theory goes that while politicians may implement painful measures earlier in their terms, once re-election looms, they tend to look for ways to boost the economy. Now, these arguments do make intuitive sense, as politicians obviously have a strong natural desire to be re-elected. But does the data support the idea that an election year is always the best time to invest? Well, as so often happens with investing, it depends on what time frame you're looking at. Historically, stock markets have indeed done well during election years. For example, between 1928 and 1996, the S&P 500 averaged gains of nearly 15%, boasting positive returns in 90% of the election years. Recently, however, we've seen enormous losses in 2 of the 3 previous election years, with the market sinking 9% in 2000 and 37% in 2008. These results dropped the annual market returns to 11%, or virtually the same as the average return across all years, election and non-election alike. What looked like a surefire bet is now indistinguishable from the long-term average. For the first 8 months of 2012, we're already up double digits, an ideal return for the entire year. However, this return has been earned in fits and starts. If investors were sure an election year would yield strong results, the market would have jumped on January 1 or even before that, as investors all tried to get in before those anticipated gains. Instead, we've seen a year full of risk and uncertainty, with moments of panic in May. The current state of the global economy, corporations, and consumers has clearly trumped any effects from the election cycle. It's easy to find patterns in large amounts of statistical data, yet patterns are only helpful if they can be relied upon to continue, and most don't. Risk and return are related, and nobody is able to consistently predict market returns in advance. Instead of trying to find short-term patterns, we believe investors should focus on the long term and enjoy stock market gains whenever they occur.